Every global asset management firm runs on a hidden infrastructure, the financial plumbing. These strict systems seamlessly govern transactions, portfolio accounting, and market data. Traditional investment technology operates under strict logic. It relies entirely on precise, standardized inputs to function, tracking a security's ISIN, its daily price, and its currency down to the decimal. But as the global economy transitions toward net zero, investment firms are being forced to ingest an entirely new class of information: climate data. This information breaks the established rules of financial plumbing. Climate data is highly fragmented. It is built on estimated models, heavily dependent on varying methodologies, and subjected to constant revision. When unstable data collides with legacy financial systems, the architecture fractures. You cannot force ambiguous metrics into models built for absolute certainty. These jagged inputs arrive from everywhere: corporate disclosures, satellite observations, and climate projections, crashing into infrastructure with no native way to process them. This friction isn't isolated to a single compliance department. Climate risk is pervasive. It directly impacts portfolio construction, risk management, stewardship, and the daily valuation of assets simultaneously. A net zero commitment redefines the technical requirements of the entire firm. This is an immediate enterprise architecture crisis. The industry's initial reaction to this messy data was containment. Asset managers quarantined climate metrics into isolated ESG data silos. They built static reporting dashboards on top of these silos. But an isolated dashboard doesn't alter front office investment decisions, nor does it factor into the firm's core risk models. It sits outside the actual workflow. To fulfill real-world climate commitments, a firm must translate its abstract ambitions into hard data structures, rigorous decision workflows, and mechanical controls. Climate data must be elevated to a first-class citizen within the investment platform. Its lineage, provenance, and auditability must be governed with the exact same rigor applied to daily pricing data. Achieving measurable environmental outcomes requires dismantling the ESG silo entirely and wiring climate metrics directly into the core financial plumbing. The first step in building this new architecture is constructing a centralized climate data engine at the foundation of the platform. This diagram shows the data engine at work. It ingests raw climate through two distinct pipelines. The first processes absolute emissions, measuring the raw physical scale of greenhouse gases. The second handles intensity-based measures, like weighted average carbon intensity, allowing investors to compare carbon efficiency across companies with vastly different economic scales. Standardizing these metrics across complex asset classes requires advanced accounting methodologies. Applying frameworks like enterprise value, including cash, ensures emissions are mapped to investors consistently, regardless of whether they hold debt or equity. With rigorous standardization in place, specific emissions can be accurately attributed to specific investors, moving the process far beyond simply ranking securities by how green they appear. A unified data engine prevents reporting discrepancies across the firm and establishes a single, auditable source of truth for the entire enterprise. Historical emissions data has a severe limitation. It only documents what a company did in the past. Climate risk is inherently forward-looking. Consider a portfolio with low current emissions that remains highly exposed to future regulatory transition risk. Now contrast that with a high-emission industrial company actively investing massive capital into low-carbon technology. Historical data misrepresents the true risk profile of both. To correct this, the data engine must calculate forward-looking metrics, generating models for climate value at risk and tracking implied temperature alignment. Providing these projections creates a common analytical foundation. It allows portfolio managers and risk teams to reason about climate exposure using the exact same set of facts and assumptions. Measuring a portfolio's current carbon footprint is simply an accounting exercise. Understanding its actual long-term climate risk trajectory is an investment decision.
Moving up from the foundational data layer, we encounter the next architectural challenge within front office portfolio decision-making. Asset managers frequently encounter the paper decarbonization paradox. This is the illusion of environmental progress created when a fund simply sells off its highest emitting assets. This Sankey diagram illustrates the mechanics of that trade. When Portfolio A divests a high-emission asset, it simply transfers to another owner, Portfolio B. The carbon intensity metric for the selling portfolio drops drastically, looking like a massive success on an isolated dashboard. But looking at the closed-loop global emissions pool, the total volume of carbon remains exactly the same. The underlying economic activity never stopped. Portfolio decarbonization and real-world decarbonization are related concepts, but they are not mathematically equivalent. An investment architecture built solely to optimize for a lower internal carbon footprint fails to drive actual climate transition. Solving the paper decarbonization paradox requires a specific architectural capability, precise emissions attribution. The investment platform must mathematically differentiate between an emissions drop caused by portfolio repositioning, like selling a stock, and a drop caused by a company genuinely reducing its industrial output. This granular attribution data must then feed directly into the firm's portfolio optimization engine. Carbon targets do not exist in a vacuum. A carbon optimization engine operating independently will produce theoretically green but commercially impractical portfolios. These targets must compete against standard financial constraints, like tracking error, liquidity, and strict risk budgets. The portfolio manager requires a unified optimization environment. They must be forced to weigh the trade-offs of emissions reduction against financial valuation and sector exposure simultaneously. True climate integration means embedding carbon objectives directly into the mainstream portfolio decision framework, rather than maintaining a separate parallel green technology stack. If divestment doesn't reduce global emissions, the alternative is utilizing shareholder ownership through structured stewardship to force real-world transition. Traditionally, stewardship teams rely on disconnected PDFs, manual spreadsheets, and isolated proxy voting systems. This scattered approach cannot scale or integrate with quantitative investment models. The solution is building an engagement CRM, a structured system of record to track the relationship between the asset manager and the corporate issuer. In this interface, engagement objectives are transformed into trackable, structured data objects. Qualitative meeting notes are replaced by firm target dates, specific transition milestones, and strictly defined escalation triggers. If a company fails to align its capital expenditure with its stated transition strategy, the CRM automatically triggers an escalation status. This escalation establishes a mechanical, visual link to a vote against management action in the proxy voting system. The vote is no longer an isolated event. This data architecture transforms stewardship. It moves it from a vague, qualitative exercise into a measurable, legally auditable investment process. When we step back, we can view the complete integrated enterprise architecture blueprint in its entirety. Data flows continuously. A signal from an updated issuer CapEx node flows through the data engine, updates risk assessment, triggers a CRM milestone, and adjusts portfolio weighting. This mechanical loop means real-world outcomes update internal research, altering portfolio weights for the next cycle. This dynamic architecture is mandatory. Underlying climate parameters like technology costs, physical risks, and global regulations are constantly shifting. The system must adapt in real time. Static, backward-looking annual ESG scores are incapable of capturing this level of systemic complexity. They are obsolete by the time they are published. De-siloing the carbon ledger means hardwiring climate data directly into the firm's central operational nervous system. Firms that embed this architecture into their core operating models turn climate data into better investment decisions, more effective stewardship, and measurable real-world outcomes.